Hello all and happy 2025. I'm Lottie, founder of the Juris Society. We bring women wealth holders and their advisors together through education, connection and collaboration across our three pillars of women, wealth and well-being. Our private network, the Society, provides invitation-only access and knowledge to leaders in the private client and wellness industries. Welcome to the Essential Series. These are weekly webinars breaking down the world of wealth and wellness with experts in their field. I'm delighted to be kicking off this year's series as we demystify finance with Kate Tung and India Cornett from Argenta Private Capital, in conversation as they raise the profile of a forgotten and often misunderstood alternative asset class, Lloyd's of London. Over the next 20 minutes or so, we'll be taking part in a Q&A style discussion. Please note this is for education purposes only, but if you do have any questions, please do ask them in the chat or reach out to myself or the speakers directly. Just going to get them in now, and I hope you enjoy the conversation. Hello, ladies.
Good afternoon, everyone. Thank you, Lottie. Nice to be here. I'm Kate Tung. I'm a director at Argenta Private Capital. I joined the business around about 6 years ago, initially to lead the tax team. We have around 500 clients who all require tax advice and also to manage the tax affairs of our group. And then more recently, I'm now in charge of business development. So you'll hear later in this Q&A presentation that Lloyd's is a tax efficient investment. And so often discussions are around how to structure and how to get the most out of it. And I'll just hand over to India.
Hello, my name's India Cornett and I'm Business Development Manager at Argenta Private Capital. With a background in tax efficient investments, I've been working at Argenta for just over 2 years. So just to simplify my role as Business Development Manager, I maintain relationships, develop new ones and identify key opportunities. But above all, I think our role as BD and marketing as a department is to raise awareness of Lloyd's as an investment and to make the market more accessible and inclusive. Just on a quick note, as we're using slides to accompany this conversation that we're having, we have included a disclaimer. If any of you are interested in having a copy of these slides, please do get in touch with either Lottie or with us directly, and we would be very happy to share them. So I think before understanding the Lloyd's market, it's important to understand the purpose it serves, which is ultimately mitigating financial risk. Whilst most businesses and individuals have precautionary measures in place to prevent damage that could be incurred, sometimes the risks are unavoidable. So to try and prevent them from having a catastrophic impact on the owners from a financial perspective, the owners will transfer the risk on for a fee. So I guess let me give you a bit of background on Lloyd's of London. Often known as Lloyd's or the Lloyd's market, Lloyd's of London has been around for more than 350 years. Its origins can be traced back to Edward Lloyd's coffee house, which is still in the city today, and can be traced back to 1688. So it, as I said, dates back for over 350 years. The industry was born out of maritime insurance. Edward Lloyd would entertain ship owners at his coffee shop, which is where risk was discussed. It was here that the ship owners would get cover for their ships should they not return, therefore removing the financial risk. Fast forward some years, Lloyd's is a marketplace in the heart of London in which via brokers, the risk needing cover reaches the underwriters. On the screen here, we have a diagram that shows you how the market works. So policyholders sit on the bottom, in the bottom left-hand bit of the chart. They are the ones who are looking to mitigate the financial risk, and it's their business that enters the Lloyd's market through brokers. It's via the brokers that the risk needing cover reaches the underwriters, who sit in the middle. An underwriter works on behalf of a syndicate, which is the underwriting venture formed from an investor or multiple investors of Lloyd's. The underwriters work on behalf of the syndicate and mitigate the risk for a price, offering a contract to pay all valid claims. Then you have the capital advisors, so like Argenta, for instance, and investors sitting on the right, and investors who sit on the right-hand side. It's the investors who pledge capital behind the Lloyd syndicates to enable them to take on the risk, allowing them to benefit from their returns, on their investments in profitable years.
Thanks, India. So I think we'll now look at how investment in Lloyd's can complement a wider investment portfolio. And I think to answer this question, we first need to talk about the different types of investors that might be attracted to the Lloyd's market. And typically, a Lloyd's investment is suitable for high net worth or ultra high net worth individuals who will already have an existing portfolio of investments. And those individuals are likely to be interested in diversifying their investment portfolio via tax-efficient alternative asset classes. Lloyd's returns have very low correlation to other asset classes. This colourful slide shows how Argenta's clients' average returns compare to returns from 8 different asset classes over the period 2008 to 2023. This is data that we've sourced from an investment house, and it demonstrates the low correlation that the Lloyd's market has with traditional asset classes. As you can see, in 2008, other asset classes were making a significant loss, whereas Lloyd's investments were delivering strong returns. Aside from the lower correlation that can be found within Lloyd's, investors can benefit from the ability to use that existing investment portfolio as capital to support their Lloyd's underwriting. This capital is known as funds at Lloyd's, or FAL, and the investor will continue to benefit from the interest or dividends from that underlying investment portfolio that's used, as well as benefiting from any Lloyd's returns supported by the same portfolio. And when we quote these returns, so on the previous slide, these are all excluding the returns that investors can make on their existing portfolio. So in terms of what can be used, it's extremely flexible. And as long as the investment portfolio is well spread, there isn't any haircut, meaning that 100% of the value of the portfolio is taken into account by Lloyd's when determining the level of capital that's needed to support a Lloyd's portfolio. The assets that can be used need to be liquid, or a bank guarantee will need to be obtained to support a portfolio based on illiquid assets. The investment portfolio used will continue to be invested under the supervision of the client's investment manager and can therefore continue to generate returns. And in return for pledging this capital, the capital provider will receive their share of the underwriting results, effectively allowing the investors to use their assets twice. So to answer the question, the lack of correlation and ability to use an existing portfolio twice can complement an existing portfolio. So we often get asked whether the changes from the recent budget have impacted the tax relief available on a Lloyd's investment. So all new investors coming into Lloyd's must join either through a limited liability partnership or a limited company. You can no longer invest at Lloyd's on an unlimited name basis. And that limited liability vehicle qualifies as a trading activity. Therefore, the investment can qualify for business relief, subject to the usual 2-year ownership period, and ensuring that the assets within the trade are commensurate with the level of trade. We have an in-house tax team which allows us to work with new investors and existing clients to ensure their investment in Lloyd's is structured in a tax-efficient manner and allows for the passing of wealth to the next generation. In the most recent budget, there were a few changes to tax relief an investor is able to claim. However, the investment incentives are still available. So to keep it simple, historically, an investment at Lloyd's was previously entitled to 100% business relief, subject to meeting certain criteria. Following the budget, from April 2026, an investor is now entitled to 100% relief on the first combined 1 million value of both business property relief and agricultural property relief. And thereafter, assets in excess of the 1 million are subject to a 50% inheritance tax relief, so at a 20% rate. So it's perhaps not as big as incentive as previously, but that being said, Lloyd's investment still offers a tax relief to investors.
So let's cover some of the benefits that are associated with an investment in Lloyd's. To answer this question, I would like to start with a little anecdote to briefly explain how Lloyd's returns work before I talk about them. So the accounting is done in a 3-year cycle, and the reason for this is thinking back to Edward Lloyd in his coffee house. If a ship didn't return within 3 years, the chances of it coming back were quite slim. With an investment at Lloyd's, we often refer to returns as being forecast returns. So when we talk about returns for 2024, for example, they're still forecast as that year of account hasn't yet closed. Lloyd's is a cyclical market, and like all cyclical markets, there are periods of peaks and troughs. At present, Lloyd's is in what we call a hard market. This means that the returns at this point of the cycle are forecast to be particularly strong. The forecast returns for the 2024 year of account, according to our research team at APCL, could generate in excess of 25% return on capital. Importantly, it's worth noting that our clients' average annualized returns over the last 15 years, including the open years of accounts, have been in excess of 11%. So I think in summary, the key benefits of a Lloyd's investment are the low correlation with other asset classes, the ability to use an investment portfolio twice, inheritance tax efficiencies, and the average return profile of in excess of 11%. So what are we doing to raise awareness of the Lloyd's market? I think that's something that needs to be addressed. So Lloyd's is a unique market to London. We think there's no better way to gain an understanding of the market than witnessing it in person. So we encourage everyone who is interested in further understanding the Lloyd's market to come with us and do a tour of the iconic Lloyd's building that can be found in the heart of the city. It is here that you'll see the brokers queuing to meet underwriters to discuss risk that we spoke about a little earlier on. If you'd like to come and experience this for yourselves, please do get in touch with either Kate or myself. As a members agent, we have also been working on our brand awareness through an improvement of communications and literature. We believe that simplification of the market and of the literature we are creating is key, as after all, Lloyd's is often associated with being a complex product. This goes hand in hand with the significant improvements that we have made to our website and our LinkedIn page. We believe that these platforms should be a hub for learning, and therefore quality, digestible content is key. Finally, Lloyd's has often been perceived as a sort of club for male investors of a certain age. Slowly, investor profiles are changing, and as a capital advisor, we try and cater to our clients' needs and requirements. Therefore, we have started introducing new products that might be more suitable. For instance, products with lower capital requirements that introduce investors to the Lloyd's market for a finite period of time.
So I think I'll just touch on what we're doing to try and help educate people on the market. So just looking at a few common misconceptions, and I think one of the key misconceptions associated is that Lloyd's of London has nothing to do with Lloyd's Bank. And secondly, Lloyd's is not an insurance company. It's actually a marketplace. And India showed that diagram of the marketplace earlier on in the presentation. So many people we talk to about an investment at Lloyd's still see Lloyd's as a sort of members club where you join as an unlimited name. They remember the 80s and 90s when many investors unfortunately lost everything. Things have significantly changed since then, with new investors only being able to join with limited liability, meaning that the maximum amount at stake is what they put into the vehicle. And like many other asset classes, Lloyd's is now a highly regulated industry. The businesses that manage the syndicates are regulated by the Corporation of Lloyd's, the FCA, and the PRA. Another point we get asked a lot about is volatility. Many people believe Lloyd's returns are very volatile. However, our clients have enjoyed average annualized returns in excess of 11% over the last 15 years, from 2009 to 2024. And 2023 is forecast to produce returns in excess of 25%. Just going back to our colourful slide comparing other asset classes, you can see that the worst loss our clients suffered was a loss of 14%, and Lloyd's returns have been in the top 3 performing classes in 9 out of the 16 years shown. Clearly, there are other asset classes which are more volatile and have generated higher losses than 14%. So like other markets, Lloyd's is a cyclical market, and it's our job as members agents to advise our clients on their underwriting decisions and help manage that volatility so that returns can still be made across the cycle. Capital comes into the market during periods of high profits, driving prices down. What is meant by this is that in a competitive market, underwriters will lower their prices to win business. When rates are low and a significant event or loss happens, like a hurricane, capital providers make a loss themselves. This subsequently drives capital out of the market and helps to increase the rates set by underwriters. The complexity of the market is often something that gets raised. Lloyd's has been associated with being complex and hard to understand, which we acknowledge it is. However, as India said, we've made a conscious effort to simplify our written communications, video clips, and other literature to help people fully understand the investment opportunity and to make the nature of the industry more inclusive. We're introducing new products to cater for the different needs of potential clients and investors, such as lower capital requirements and creating a more passive investment opportunity. And finally, the topic of risk often comes up. Lloyd should be considered to be a high-risk investment, and there'll be years when underwriters will not make an underwriting profit, and that will affect your returns as investors. However, as mentioned, it's no longer possible for new investors to join with unlimited liability. Looking at the unprecedented wildfires in California as an example of a catastrophic loss, where there are sadly 24 confirmed deaths and estimates of over 12,300 structures having been destroyed, the preliminary losses are estimated to be between 135 billion and 275 billion US dollars. This materially exceeds damages from previous significant wildfires in 2017 and 18. So from a Lloyd's perspective, whilst there are specialists actively providing cover for wildfires, Lloyd's as a whole has reduced its exposure following the losses in 2017 and 18. And historically, Lloyd's share of losses tends to be around the 6% of market insured losses. If insured losses are at the higher end of those estimates, this would equate to around a 5 or 6% movement on results in a year which we are still anticipating will be highly profitable. So thank you all for listening. It'd be lovely to have any questions if there are any.
Amazing. Thank you so much. Yes, a couple of questions did come in, actually. The first one is, what is the minimum requirement when investing in Lloyd's? I know you've given a couple of figures, but if you could just expand on that a bit, that would be helpful.
Yeah, I'll take that one. So thank you, Lottie. I think that is a really good question. Generally, the minimum level of underwriting should be about £1 million, and depending on the portfolio of syndicates capital, between 500,000 and £1 million would be required to support underwriting of £1 million. So the capital required should not represent more than 10% of an individual's overall wealth. It's also worth an investor remembering that an investment in Lloyd should be considered a medium to long-term investment. So we're talking between 5 to 10 years.
Okay, that's really good to know. Thank you. And then I guess, how might somebody go about actually investing? Because again, it's all well and good knowing this information, but actually, what are the stages to actually get involved?
Yeah, thank you, Lottie. So I think this would start with probably an initial discussion with either me or another director to get an understanding of what the potential client's looking for and what an investment at Lloyd's has to offer. And from there, we would encourage them to have a face-to-face meeting to discuss the structure options and possible entry routes. And this will all depend on the stage of the market that we're at and what the potential investor is looking to achieve. So providing the meetings a success, would then work with the client to determine their portfolio. So there are around about 30 syndicates that accept third-party capital. And as a members agent or capital advisor, we recommend around 15 of those.
Mm.
So the portfolio out of that 15 is really determined by the investor's risk appetite. And going forward, they'll work with an appointed client director to make any changes to that portfolio year on year. So once the entry route's decided and the portfolio has been confirmed, we'll then talk about how they get the capital that's needed to support that portfolio and how it's best provided. So there are many options. They can hold it in their own name in an existing family investment company, or they can transfer it into the Lloyd's underwriting vehicle itself. And there are different tax consequences associated with all of those.
That's really helpful to know as well. And then I assume you must then work with other professionals in order to wrap this all up and tie it together and make it cohesive and effective. What other market professionals do you actually work with?
So we briefly touched earlier on the fact that we what our objectives are as a business development and marketing team in terms of trying to simplify and the market and make it more accessible. And this means that we're relatively active within the market. So we work with a number of market professionals. Notably, we have good relationships with the Lloyd's appointed investment managers who look after the investments held in FAL as collateral. We also work closely with law practices when an investment involves a number of family members. With all the tax incentives a Lloyd's investment has to offer, we are often asked to carry out CPD sessions and to tax advisors and financial planners. And as an alternative asset class, we regularly get asked to sit as guest speakers on a variety of panels presenting to introducers, intermediaries, and of course investors.
Well, we're very lucky to have you to share your knowledge with us. Thank you. Last but not least, just wondering, have you got anything new and exciting that you're working on that's coming up on the horizon? I know you mentioned there were a couple of little new products, for want of a better word, that you are working on. Could you share a bit about that?
Yeah, I think it's constant change in the market, and we're always working on something new, as India said, to try and tie in with investors' appetite and changing needs. But we have launched a new product in 2025, which we're excited about, which we've affectionately called a starter home, where we're working in partnership with Helios Underwriting PLC. So a starter home is basically a company or a limited liability partnership which was set up to participate at Lloyd's from the 1st of January 2025. And it's on a diverse portfolio of syndicates. And the company or LLP gets access to that portfolio for a rental fee, whereas traditionally they would have to buy access to those syndicates. So it allows investors or new clients to get access to 2025, even though the year's already started. And it allows them to use all of their capital to underwrite, which is taking advantage of the really strong market conditions. There are a variety of different sizes of investment vehicle to suit the investor's needs. And they're really just an entry point for investors. And so once they're in, they can amend the portfolio from 2026 onwards to suit their risk appetite and investment aims.
Fun. Really exciting. Well, wow. Thank you guys for sharing all of that information with us. As we mentioned right at the beginning, if you do have any questions or you'd like to learn more, feel free to reach out to Kate, India, or myself. And we'll be very happy to share more information with you. But thank you all for tuning in. Anyone who's watching it on the replay as well, very welcome to reach out to us too. But yeah, thank you so much, Kate and India, and enjoy the rest of your week.
Yeah, thank you, Lottie. It's been a pleasure.
Lottie.
Thank you. See you soon. Bye.
Thank you.
Bye.